We've seen various large American banks, turning bullish on gold. I mean, Jamie Dimon said he wouldn't be surprised if it went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is they've turned bullish. And from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why, if someone told me that there was a coordinated move to basically bash gold and silver and also platinum group metals lower, I could believe it.
Gold, silver, and platinum prices have experienced a sudden and violent pullback, one that has caught many traders off guard. Gold fell nearly 5%, silver dropped around 7%, and platinum group metals slid by almost the same magnitude. For casual observers, it might appear that the precious metals bull run has stalled, or even reversed. But beneath the surface, this sharp correction looks far less like a market-losing conviction, and far more like one being deliberately shaken. Alasdair Macleod, in his latest interview, offers a view that cuts through the noise. What we've just witnessed may not be a sign of weakness at all, but the result of strategic positioning by the same powerful institutions that have long dominated the metals market. Historically, bullion banks and large derivative players have shown a near-instinctive ability to act in unison when gold and silver start rising too fast. When sentiment turns bullish, as it recently did, with even establishment names like J.P. Morgan's Jamie Dimon acknowledging the possibility of gold hitting between $5,000 and $10,000, and Morgan Stanley advising clients to allocate 20% of their portfolios to gold, the banks that trade on the other side of those positions often move quickly to restore balance. The resulting volatility tends to flush out speculative longs, narrow their own exposures, and reset the price floor. But if this really is such a coordinated shakeout, it may also be a sign that the upward momentum in precious metals has grown too strong to ignore. Data from the futures markets support this interpretation. Open interest in COMEX gold remains less than half its long-term average, suggesting that this rally has not been driven by excessive speculation, but by structural demand. Central banks, particularly those outside the West, continue to accumulate at a record pace. Retail investors, burned by years of paper gold manipulation, have turned to physical holdings. And large hedge funds, many of which missed the early stages of this rally, are now beginning to shift their positioning toward long exposure. The market, in other words, is consolidating strength, not losing it. These dynamics point toward a potentially explosive setup for the months ahead. Every attempt to suppress gold and silver prices in the past decade has ultimately given way to stronger rallies once the forced selling subsides. With inflation remaining stubborn, sovereign debt ballooning, and global trade realigning toward commodities and hard assets, precious metals continue to offer the kind of asymmetric protection that few other assets can match. The real story may not be the temporary fall in prices, but what, and who, comes next when the consolidation ends. In this discussion, Alasdair Macleod dives deeper into these forces, not just the mechanics of the current correction, but the larger geopolitical shifts shaping it. He explores how China's quiet construction of a gold-linked trade network could signal the emergence of a new Bretton Woods moment, one where gold once again anchors global commerce. He also outlines how central banks in the global south are positioning themselves for a post-dollar monetary order. If you find this analysis valuable, make sure to like this video and subscribe. It helps more investors discover in-depth discussions like this one. Thanks, and let's dive right in.
I think basically, when you look at how much gold and silver and indeed platinum group metals have soared in recent months, some sort of correction was definitely on the cards. But the interesting thing is that the whole thing has really been a short squeeze. If you look on COMEX in particular, the speculators are just not there. I mean, they haven't really bought into it. The way I would measure that interest is looking at open interest. An open interest in gold is less than half the long-term average. Open interest in silver is roughly at the long-term average. I mean, there are obviously a few speculators in there, hedge funds, whatever. Not all that many. So this shakeout, it looks sort of suspiciously coordinated. I don't mean that, over the weekend, various bullion banks got together and had a meeting and decided to bash the market. But you do get this feeling, when you're a jobber. I mean, I've known jobbers, which is really what they do. I mean, the market maker is a jobber, basically. I've known these guys. I've been on the other side of them since 1970. And they do have this sense, if you like, in the market, when it's right to bash the price of something which they're short of. It's almost like a second sense. And if they haven't got it, they're not going to survive terribly long in whatever they're dealing in. So if one good dealer has got the feeling this is the moment when it's going to come off, the others also have the same feeling. So, you get this sort of compounding effect. And of course, I think what the buyers are doing in this, and remember, we're not talking retail market here, we're talking about wholesale market, and we're talking about big derivatives. The buyers, I think, they would just sit on their hands and watch this play out a bit before they decide, shall we buy some? And if so, what's a level? And so on and so forth. So, this is why I think this shakeout has been so severe. I mean, I'm looking at what's happened in silver. I mean, silver is down nearly 7%. Platinum's down 5.7%. Palladium down 5.3%. And gold, as you said earlier, is 5%. I mean, these, given the rise that we've seen, this isn't actually all that great. I mean, you would just say this is volatility. I've always told people, don't trade this market. I mean, you'd be nuts to trade it because the guys on the other end are so powerful. They'll take every cent you've got off you if you're going to trade it. And, the answer basically is that you've got to work out why you're interested in gold and silver. You've got to understand what gold and silver are. I mean, particularly gold in the current context, what it is. You've got to understand that it is legal money without counterparty risk. Forget what the US Treasury says about gold being a pet rock or whatever. The reality is that in our common law and in everyone's common law, gold is money, it's final settlement, there is no counterparty risk. And the volatility isn't so much in gold. I mean, obviously there's been volatility in gold, but it's mainly in the currencies. So when you see, for example, the People's Bank of China buying gold, the way to look at it is actually they're selling dollars. And they have other use for those funds. But basically they don't want dollars. So that's, if you like, the sort of their gold purchases are almost the small change, which they haven't got any other use for because they've got quite enough gold. I mean, not necessarily within their reserves, but the nation has lots of gold spread around various accounts, including the People's Liberation Army, the Communist Youth Wing, and so on and so on and so on. So that's the way to look at it. So you've got to think, okay, do I buy gold because I think that paper currencies are going to lose purchasing power? If you think that, then the answer is yes, and you hold it, you hoard it, you tuck it away. Otherwise, don't mess with it. Forget it. It's a waste. You'll just have sleepless nights if you try and trade it, because I can tell you, you try and trade this market, they will take you for every cent you've got. That's the reality of it. I think there's another point which is worth making. We've seen various large American banks, turning bullish on gold. I mean, Jamie Dimon said he wouldn't be surprised if it went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is an extraordinary statement from an establishment bank like that. I could imagine that Scott Bessent would sort of phone him up and say, why are you messing up my world? You know? But so, they've turned bullish. And from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why